Welcome to TheoTrade. This is Don Kaufman. July 26th, 2024. 15 minutes to go to the cash close here on this Friday afternoon. S&P futures up some 1%, better known as 57 handles. But I have to tell you, we are way off the highs, and this marketplace has just turned in to Mr. Toad's wild ride after the last couple of trading sessions. Look, the volatility beast is waking up. That and much more here, of course, on this weekend's update. Let's get right down to business. Look, you can scream all you want about the fact that the S&Ps are up right now, some 57 handles, but there is a whole lot left to be desired in this marketplace. The first bullet I've got up here pretty much screams it out. Look, keep those helmets on, people. That basically implies that there is a lot more volatility to come. And I just wanted to kick it into high gear right off the bat here on the update, saying just that. When I say keep the helmet on, look, you see a marketplace that's rebounding here a little bit, but overall, let's actually cruise to the SPX, the mother of all products, and I want you to look at the expected move. So it does appear, even with 15 minutes to go, nothing's certain in this marketplace, but with 15 minutes to go, I'm assuming that we're going to close inside the expected move this week in the S&Ps, but the price action that we saw this week, look, we hit the upper edge of an expected move. We crossed the lower edge of the expected move, and that basically happened in a very, very short window of time. The bounce today, of course, you're going to look at it and say, oh, it's significant. But when you start digging down, and I'm going to do that in just a moment here, you start digging down to what actually caused today's bounce. It's not exactly a calming, aspect. In fact, it's a little bit more alarming, especially which I'm going to, turn around and talk about in a moment. Like, look what's leading this rally right now. And I got it. The S&Ps are up 1%. It's the quintessential rip your face off rally. But doesn't it concern you that the financials are leading that rally? I often make, I think, this analogy, and this analogy does it the best. In a marketplace that's seeing like this rotation game, we've seen this constant rotation. Let's get into tech. Let's get out of everything else. And all of a sudden, let's get out of tech and let's get into the financials. Well, here you have the financials. You have tech up, listlessly up, but it's the financials that are kind of leading the way. And I'm going to come more into this, but the analogy that I give you is, if you're in a sinking ship and Jamie Dimon comes by in a lifeboat, of course, Jamie Dimon heading none other than JP Morgan, do you get in the lifeboat with him? Because a lot of us, including myself, would probably be like, yeah, you know what? I'll take my chances out in the great blue sea before I actually hop into any lifeboat with Jamie Dimon. That's the way I look at, the financials actually leading, if you will, at a point in time like this. All right, and I'm going to get into specifics as to why here in a moment. So I start with, again, keep those helmets on. Let's get a quick read on volatility. Okay, look, a lot of people do, look at VIX. I got it. The VIX is, I call it my predecessor's volatility indicator. Nevertheless, look at the VIX, love the VIX, hate the VIX, doesn't matter to me. The VIX actually is contracted to some degree today. But the one, I think, overwhelming aspect of looking at the VIX at this point is, oh, people, come on, it didn't even catch a real stride. Maybe just started to catch a stride. And I put that right in the notes over here, like volatility. Okay, it's waking up a little bit. But again, a little perspective. You got to crack 20 to even raise an eyebrow. Okay, let's go a little further back. Let's go on a 3-year. And again, perspective is everything. And when I actually zoomed in over there, I intentionally did that. I zoomed in. This is a 9-month daily. You're like, oh, look, man, that was off 22. And yet all of that pales in comparison when you start actually bringing up a 3-year. And let's be honest here. 3-year doesn't include, of course, even the COVID times. You actually snap a little further out. You go to 5 years and you go like, holy 85. All right, but let's not get that extreme. But in a 3-year, okay, we're not anywhere near the kind of volatility that we could see. Now, looking at VIX and VIX alone and saying that, volatility hasn't even caught its stride yet, okay, that is not meant to intimidate you. That is not meant to tell you that I can see anything. I cannot see anything when I look at a VIX chart. Okay, VIX is just, it's an equation. It's reactionary to whatever's going on inside of the broader market. Nothing more, nothing less, period. But I can dig a little bit deeper. Before I go to the volatility futures, I am going to go to the VVIX. The VVIX is the volatility index. Okay, now the VVIX, ooh, it almost caught the 110 level yesterday before reverting back down. The VVIX is actually giving you a feel for volatility in the VIX itself. And the volatility of the VIX is, well, extreme. Like when you guys look at stock, you're like, oh, what's a volatile stock? You go, oh, Tesla's a very volatile stock. Okay. Let me tell you, the VIX right now is sitting at 95 vol. The VIX is at a 95 vol. Where's Tesla at? Okay. Where's Tesla? Oh, Tesla has what, a 50 vol? Okay. Roughly speaking, the VIX is double the volatility of a Tesla. So the VIX into itself is a, it's an untamed animal. And that has definitely picked up. Okay, this is definitely a warning sign, no question about it. So even though it's crushed down today to the tune of 8%, it didn't crush down enough to actually sign the, big sign the waiver out there. It's all clear, fly the flag of all clear. We're far from it. And I want to make that very clear. That one is a bit more of a statement where we actually came up just shy of that 110 region. We've pulled back, but again, definitely not sounding the all clear. Why do I care about what VVIX says more than VIX? Because this is real trade. Okay, where when you look at like VIX, it's just an equation off of the puts that trade in and around the 30-day, yada yada yada. Okay, it's the volatility of the SPX, and it's based on bids and offers, yada yada yada. But the VVIX, okay, is actually the volatility from the VIX itself, and the VIX is the options are a tradable tangible instrument. So I do pay careful attention to this, because if they were really going to say like, all right, all clear, they'll crush the volatility of the VIX. This actually indicates the exact opposite. There's hedging activity going on. All right, now for volatility futures. Now the volatility futures, okay, it's such a strange looking chart. Here's another one, definitely not sounding the all clear. The volatility has come in a little bit today, but again, some perspective over here. If anything, this one promotes risk is still coming. I'm just going to be very clear. This promotes risk is still coming, because although the volatility future came in, when I say came in, it actually went down. Okay. It didn't even get, and it's going up right now. It didn't even get to yesterday's lows. So this is a, I'll say this as eloquently as I can. This is a crap fest in the making. So wake up, because right now you need to understand that volatility has not crushed. This is the kind of volatility that really, this will crush you if you don't understand. Okay, what I'm effectively saying. We never went into backwardation. Once again, what that basically implies, I'm going to freeze the screen really quick over here. What this basically means, when you look at volatility futures, you can look at the 26-day, that's the August volatility futures, okay? And I want you to look at that, and then I want you to look with me here at the 54-day, this is the SEP vol futures, okay? So we have the 26-day, the Augies are trading at 1620, okay? The SEP is trading at 1675. When the proverbial crap really does hit the fan, the August volatility futures, okay, will go over the September volatility futures. I was talking about that because what that basically screams is risk is right now. It's not tomorrow. It's not the next day. It's not in the future. Risk is right now, that the risk right now is more extreme than it will be in the future. And that's why I say, like, we're just starting to maybe catch a stride, but we're very far from home. And again, I can't stress enough with looking at the VVIX and looking at the vol futures. Okay, these are actually projecting, if you will, more risk is forthcoming. And by the way, why say it when you could just look at it on the screen? Okay, the marketplace. I wasn't joking a moment ago when I said in the SPX, look, we're closing. Look, we're closing inside the expected move. Okay, except I was hesitant even saying that. And look, there's 5 minutes to go to the cash close, and the S&Ps are descending just a bit over here. The lower edge of the expected move is 54.20. And by the way, boy, did I talk about that on Wednesday night video, and that thing came to fruition and then some. Okay, moving along. So we talked a little bit about volatility and, well, why right now, okay? The proverbial crap can hit the fan very, very quickly. All right, Next thing, NASDAQ lagging is a considerable concern. If there's one thing to me that points to risk, probably more than anything on the screen, even beyond like volatility, go look at the NASDAQ. Okay, let's just point out it's the NASDAQ. Okay, that got the S&Ps to where the S&Ps were. Okay, not that where they are right now, but what got the spider, if you will, okay, to 56, okay, 5, right? So I'm so used to looking at the S&Ps, 565, or okay, in S&P terms, 5721, right? So what got it up here? And I'm going to tell you exactly what it got. It's the NASDAQ. It's the NASDAQ unequivocally. Now, not to say, can the NASDAQ come roaring back to some degree this next week? Yeah, like look, NASDAQ stocks can have a rip-roaring rally. But what I don't like, okay, about what you're seeing in this marketplace right now is the NASDAQ, okay, it just, you look at it, it feels heavy. I mean, it feels incredibly heavy. I want you to look at Microsoft today because Microsoft's up 1.5%. It's a rip, okay? It is a rip. Its earnings are coming out, so look, that's going to be kind of wild next week. There's a lot of things that are going to happen wild next week, but the bounce today is meager because when you start looking at the bounce, yeah, what we're doing is a bounce right back to the lower edge of expected move. Okay, that is a not a good sign. So that's something that, again, I don't think a lot of people would have caught that the bounce today. You're like, yeah, that thing is bouncing, man. I don't even know what he's talking about. Yeah, I actually did look at that and know exactly what I'm talking about. And the bounce back to expected move is just catching the edge, okay, of, well, what was expected. And that's hedging activity that's actually driving us to the edge of the expected move. Nothing more, nothing less, because that's not much of a bounce when you bounce back to the lower edge of an expected move. Meanwhile, taking a look at stuff like Apple, lower edge of the expected move. Again, it doesn't matter what you think about the bounce inside of Microsoft. Okay, what it comes down to is, oh, it's 1 point. It doesn't matter. It's a grab, okay, in hedging activity. Taking a look at Amazon. Amazon finished the week roughly flat. That's like, one of the leader of the pack. Okay, Google, that thing cracked the lower edge of the expected move. Now, this is kind of news driven and had a lot to do with ChatGPT. I get it. Okay, then we got Meta. You're like, oh, Meta. Yeah, Meta got absolutely walloped throughout the course of the week. It did bounce back inside the expected move. Of course, you've got Tesla. Tesla right now reaching for the lower edge of the expected move. It is not going to make it. And of course, NVIDIA. Okay. Now, NVIDIA, here's another one that's fairly pivotal. Okay. NVIDIA kind of feels like it fell off everybody's radar screen, but NVIDIA at this particular point, I'm going through individual stocks. NVIDIA, again, catching lower edge of expected move, nothing more, nothing less. Okay. There are big concerns in the NASDAQ because if the NASDAQ is what got us there, okay, and the NASDAQ right now on a percentage basis, it's lagging, okay, and which leaves what? What do you really have? And I'm an honest answer to this. What do you really have? It's going to drive this marketplace higher. You either get a bounce out of tech, okay, or you're done. There's no conversation here. You either get a bounce out of tech. It better be a rip and bounce. It's got to be a rip your face off rally, or we're done. There's nothing to talk about. If you're going to sit here and try to convince me that the financials, they're going to lead the path forward with what? Okay, innovation and Jamie Dimon? We already went down that path. Point I'm trying to make is financials right now are leading. This is a rotation, and it's a rotation, okay, that is a little bit of a game. Okay, that rotation's a little bit of a game. We'll keep rotating, and it'll keep working until it doesn't work. I mean, look, we're buying crap like Starbucks at this point. Okay, it's not good. Again, there's stocks that haven't rallied, and I was talking about this a little bit earlier today. There's stocks that haven't rallied in months that are starting to rally, okay? And the reason is, all right, we're buying crap. We're buying crap to actually rotate because you realize, and some of the managers realize, all right, tech may be done for right now. When I talk about buying crap, I got to bring up Lululemon because this has been one of the mainstays. I keep saying that what they were doing is basically selling, okay, stuff into 52-week lows and just forcing capital into a very small hole. That small hole was known as tech. And tech, when I say it's a small hole, it's like 5, 6, maybe 7 stocks. That's it, okay? And now, right, what are they doing? Looks like they're trying to get out of it, or at least, okay, that is it for the marketplace. But it definitely appears that there is some bailing going on inside of this marketplace, and in a big way in tech. Okay, even though we're rebounding over here, like if tech isn't going to carry us, we're in trouble. and that's going to be felt early next week. Okay, there's also been some degree of upside correlation. Here's another one where we just haven't seen great degrees of correlation. We keep seeing these rotations, okay, but this is greater degrees of correlation. I think this could play a more significant role early next week, both to the upside and the downside. As I said, tech's got a rip, okay, or this marketplace is just over and done with. As I was saying, financials are leading. I beat this one up pretty good at this point. But again, as I said, I don't think financials are going to be able to be capable of holding this marketplace together. Why? Right? Well, let's get really specific. All right, the bonds have turned around and rallied a little bit in the last two trading sessions. And you realize that the bonds, when the bonds are rallying, okay, that implies that what? Interest rates, okay, if you guys are not familiar with rates, interest rates are going where? Down. So we're looking right now at a situation where bonds are rallying. Now I'm going to show you the interest rate. Interest rates going down. Don't the financials like higher interest rates? And the answer is yes. But the financials, okay, and many of the financials, and to be very, very specific, the regional banks, okay, if you guys haven't looked at like regional banks, check out this ETF, the KRE. That thing's been one of the most explosive moves. You want to know why the KRE is rallying? It's for all the wrong reasons. Because they're already pricing in the Fed. The Fed, they're going to cut rates. Wait, but cutting rates doesn't help the financials. It does when the financials, okay, the financials own tons and tons of bonds, okay, hundreds of billions of dollars of bonds. And guess what? If they bought bonds anytime in the last 5 years, okay, they're underwater. Like unless they bought bonds like at a specific point in time, basically everybody that's bought bonds in the last 5 years, okay, from the notional value is underwater. And I'm not saying they could hold those bonds until maturity and they can get back, to parity, yada, yada, yada. Yeah, I got that. Okay, thank you, Captain Obvious. But all the banks are actually sitting, specifically the regional banks are sitting, okay, on billions and billions of losses. So now that the bonds are starting to recover to some degree, yet you're seeing a rip roar and rally specific inside of the regional banks, because what it's doing is taking those unrealized losses and mitigating some degree of their unrealized losses, right? And that's in large part why the financials are leading. It's not a good reason to lead. It means you suck a little bit less than you did last week. Okay, so it really is. That's how bad it is when you're looking at the financials, and that's why I'm so just I'm not trying to be complacent in any way, but I'm looking at the financials, thinking to myself like this is ridiculous. When the financials are actually leading over here, that's not going to hold the marketplace together. All right, so we had PCE data that came out today, and the PCE data came in a little bit hot. So that basically implies inflation's not necessarily dead. Doesn't matter. The market actually still rallied a little bit. Okay, a little bit. I mean, up to the tune of 1%. That's a meager rally. Like I'm not saying that we can't rally on Monday, but okay, the Fed, they're not going to do anything this next meeting, but some of their verbiage and some of their rhetoric could be a little bit hostile. Look, the marketplace is assuming 100% chance that the Fed, okay, is going to cut come September. And some of those expectations are built into this marketplace, okay? They may get diminished in this next Fed meeting. So the Fed's back in town. With the Fed coming back into town, and again, I don't care what you think about the PCE data. It doesn't matter. Inflation's coming back a little bit. The Fed could get a little bit more hostile. What I do care about, though, is the expected move next week. And I'm going to tell you exactly why I care about the expected move, because put on your big boy pants. $105 expected move. Now we just came out of kind of a wild week, and the kind of wild week had an $5 expected move. Okay. Oh, now we actually just packed 20% more risk into the week. You've got big earnings coming up, big earnings. So if you're kind of curious about NASDAQ, I made some statements about NASDAQ. The NASDAQ has to lead. Okay. But all of the biggest of the NASDAQ stocks are coming out with earnings this week. If it's going to lead, it's going to be this week. But at the exact same time, okay, you could get a dose of reality thrown at you by the Fed. People were coming in, okay, to a very, very pivotal week where, again, $105 expected move. I've seen much bigger than that. But you got to recognize, okay, that volatility beast, it has not been unleashed yet. The volatility beast is just waking up. And that's exactly how you want to approach this marketplace this next week. If you got knocked around in trade at all in these last 2 weeks. Okay. Look, use again, discipline, come in there, trade when you want to, not because you have to, cut size. And I'm telling you, get ready for wild two-sided action. Thanks everybody for joining us here at TheoTrade. Now stay tuned for this very important message. This is Don Kaufman here, reminding you to check out Gianni Dipoce AI timing webs. Cruise over with me here to theotrade.com/web. Again, that's theotrade.com/web. Learn everything about Gianni Dipoce's AI timing webs. Thanks everybody again for tuning in to TheoTrade. And again, take a look at this video over the course of the weekend, theotrade.com/web.